Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's July 4th, 2013. Stock prices went on a bender last week, up 3 to 4%, and a continuation rally from the previous week's jobs report had gasoline thrown on it by a fairly innocuous remark by Federal Reserve Chairman Ben Bernanke. In response to a question after a speech he gave, Bernanke said, as he's been saying all along, that the Fed intends to remain very accommodative for a long time. Well, that set the trading programs on buy again, the herd back into stampede mode, and the S&P finished out the week with a record closing high, although not the intraday one. So it was a perfect Goldilocks week. On the one hand, you have the head of the country's central bank saying essentially that the economy is fragile enough that the bank needs to remain extraordinarily accommodative. And extraordinary is the term that the central bank itself uses. While the business press and the media are talking about how robust the U.S. economy is, presumably because the jobs number had beaten estimates and because stock prices are up. And as we all know, the market is never wrong. If an artist is someone who can hold two opposite viewpoints simultaneously, as F. Scott Fitzgerald once said, then this market is certainly an artist. So what will the artist be looking to do this week? Well, the basic sentiment is still wanting to go higher. The recent seasonal pattern is that the market squeaks out another gain in this first full week of quarterly earnings before turning sideways in the last week and then starting to fade. So that favors another gain this week. To do that, we have to get past the retail sales number on Monday without any ugly surprises. And then on Wednesday and Thursday, Chairman Ben will be speaking again, testifying before Congress. Let me say from the first, I have no idea which message Ben will be pushing. It's been suggested that when Bernanke tries to speak for the whole Monetary Policy Committee, he comes across as more hawkish, and when he wants to give his own opinion, he sounds more dovish. Who knows? It could be a bland appearance that allows the market to believe whatever it wants, or there could be fireworks. I just couldn't tell you. What I do know is that the market is obsessed over Fed policy to the exclusion of almost everything else, and that is not a healthy sign for the longer term. In 2007, we had a market that rallied in a very similar way, completely focused on hopes of a Fed rate cut that was always just around the corner while ignoring everything else. That market topped out in October after finally getting its rate cut, and then it was a long slide down. That doesn't mean 2013 and 2014 will be the same as 2007 and 2008. One thing that is the same as 2007 is the smugness on the part of the bulls. So unless Bernanke says differently, expect more of the same this week. But also like 2007, maybe this is a rally not to fall in love with. I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.